Tension between Egypt and Ethiopia does continue to escalate over the continued construction of an enormous dam which is designed to harness the waters of the Nile. Ethiopia is spending about 4.7 billion American dollars on what will be Africa's largest hydroelectric dam to date once completed. The Grand Renaissance Dam, as it's known, will have an installed generation capacity of about 6 gigawatts, but countries downstream, especially Egypt, are deeply concerned about the impact this dam will have on their water supply. CCTV's Gurum Chala has the details on what this project means for Ethiopia.
Ethiopia's massive hydroelectric generating dam under construction with huge amounts of public investment and now 21% completed is still at the center of controversy in the region. This dam is obviously seen as a national emblem, a means to escape poverty and above all, a means of national pride for Ethiopians, as Abai, the local name for the Blue Nile River, was untouchable for generations.
The construction of this dam gives Ethiopia lots of benefits, ranging from hydroelectric power generation to better economic growth. The dam was our dream for a long time, and now that it is under implementation, we are so happy and full of hope.
Once again, the scheme of the dam's construction is under fire because of concerns from Egypt. Egypt claims Ethiopia has not thought hard enough about the impact of its ambitious dam project along the Nile. The presidency of the country was citing the finding of a report put together by a panel of experts from Egypt, Sudan and Ethiopia on the impact of the dam. Last week's diversion of the Nile water by Addis Ababa has triggered apprehensions by Egypt, but Ethiopia has maintained there is no harm and won't be any even in the future while it's using the waters of its share of the Blue Nile. Now, the redundant question is, studies undertaken for the construction of this massive dam were inadequate for a project of this scale. Paradoxically, however, the pride and joy of Ethiopia's plan of harnessing its waters, the Grand Renaissance Dam, is said to involve deep-rooted study in almost every aspect.
It is simply to change the river flow to another direction to make a convenience for the geological investigation and the construction of the dam.
We believe the construction of the dam should not harm the benefits of the downstream countries. This is something that is well researched and prepared for. What we are saying is, let us use the water of the Nile together.
6,000 megawatts of electric power generation is what is expected out of the would-be Africa's #1 dam, though it still continues to also generate confusions between the nations, particularly Ethiopia and Egypt. Despite the fact that the construction of the Ethiopian multi-billion-dollar hydroelectric generating dam is under serious criticism and became a reason for Egypt to get worried, there is no sign from the Ethiopian side that implies any possible compromise over the execution of the plan. Aiming at clearing the pertaining confusions over the use of the Nile, diplomatic efforts are functioning at the moment from both sides to iron out a way forward. Gurum Chala, CCTV, Addis Ababa, Ethiopia.
Sudan's economy, in the meantime, has bought itself quite some breathing space after Iraq agreed to export oil to the economically beleaguered nation while accepting deferred payment. Sudan's investment minister made the announcement after a trip to the Iraqi capital, Baghdad. Under the terms of the deal, the Iraqi government will provide Sudan with oil which Sudan will then pay for at some point in the future. A technical team from Sudan's petroleum ministry is already in Iraq at the moment discussing technical issues of the deal in terms of shipment volumes and payment structure. Sudan has been struggling to meet local demand for diesel and other oil products since losing most of its crude output with the secession of South Sudan in 2011. Oil used to be the main source of revenue for the country's budget and the foreign exchange it needed to pay for its imports. Disappointing growth so far this year and renewed social tensions are compounding South Africa's economic woes. Now, last October, Standard & Poor's cut South Africa's rating by 1 notch to BBB, citing worries that strikes in the mining sector could hurt growth and reduce its fiscal flexibility. It's taking a negative outlook on South Africa yet again, leaving the door open to further cuts by citing various factors which it says may negatively affect Africa's largest economy. Now, the flare-up of unrest this week following the shooting of a mining union member is just one of the many things adding to more worries, not to mention an expected surge in inflation due to an increase in earnings by miners in the public sector. With over half the country's exports coming from mining, analysts are worried that further production cuts could cause more widespread damage in the real economy. In a rejoinder, however, South Africa's Reserve Bank said that recent local data pointed to economic growth projections for this year being cut, while sharply rising labour costs due to high wage settlements also pose a risk to headline inflation. Now let's examine another line of argument on what's going on in the South African economy. What effect will the rand's weakness have on headline inflation in South Africa? That's a question I put to Standard Chartered's head of research for Africa, Razia Khan. Her response? So it's mostly a question of perspective.
There's no indication that inflation might be sustained well above the target for a lengthy period of time. Even now, our forecasts tell us that even though the inflation outlook may be somewhat impacted by recent volatility in the rand, A, we'll need to see if it's sustained, B, we'll need to monitor very carefully what happens with demand to get any sense that South Africa will have above 6% inflation on a consistent basis. For the moment, it's still not that clear. So, yes, the South African economy has been weak. Yes, the higher frequency indicators have been worrying. It's not quite clear where the growth is going to come from, but there should be little doubt in anyone's mind that the recent weakening of the currency is something that ultimately helps, especially in terms of the performance of those external sectors.
Major South African economists in the meantime are now a worried loss. They've raised quite a bit of concerns about the rand. Many believe the unit is now extremely undervalued. The currency has lost over 14% of its value, 18% if we're using today's numbers, since the beginning of the year, largely as a result of labour unrest in the mining sector and the resultant economic fallout from that. As CCTV's Sumitra Naidu reports, the rand's fall may trigger the Reserve Bank to cut rates.
From being one of the best performing currencies amongst emerging markets in 2012 to being the worst in 2013. The rand has been falling steadily this year. It dropped sharply on Friday, hitting 10 rand 28 to the US dollar, a drop of around 17% from the beginning of this year. Analysts say the rand's fall is in line with other emerging markets.
The sell-off has started already weeks before. People are worried about, the sell-off in emerging markets. Guys are now taking profits from emerging markets. If you look around, look at the countries like Brazil, India, they've done terribly this year because people are taking profits from emerging markets, taking the monies to developed markets. Why? Because we're seeing a recovery in the USA. You're seeing Japan come through nicely with quantitative easing. That's shifting the balance of capital allocation from emerging markets to the developed markets.
Domestic issues are also weighing heavily. Strife in the mining sector remains a hindrance to economic growth. Mining is a major contributor to the country's GDP. President Jacob Zuma tried to assure investors, but the rand continued its slide. While many have blamed the president for making matters worse, market watchers say the rand was already heading in this direction.
I don't think this is something that a single individual can do an awful lot about. There are bigger forces at play here, and what it does require is an awful lot of those forces coming together and getting this meeting of the minds that I've talked about. So I think to put the blame onto one individual is a bit unfair, frankly.
The rand slide is now putting even more pressure on the Reserve Bank. Even though inflation is ticking up, the bank may have to cut rates to help stimulate growth. But the rand's weakness will add to inflation, which economists fear will place South Africa in a more volatile situation. A weak currency can be beneficial for exporters, but manufacturing is currently taking strain. South Africa is importing more than it is exporting, which means that consumers will be in for a tough time as they pay more for everything, especially food and fuel.
Economists are divided on what the Reserve Bank should do with rates, but they're in agreement on what government needs to do in order to stop the rand slide and lift economic growth. They believe that investors need more certainty and that the country's leadership needs to show more resolve in addressing the mining issue. Sumitra Naidu, CCTV, Johannesburg.
Let's put the rand's losses into perspective for you. In the year to date, Brazil, Russia and India's currencies have fallen by between 3.9% and about 6%. South Africa's, if you use today's numbers, 18% lower against the American dollar. Let's get some more details from CCTV Sumitra Naidu. She's live in Johannesburg tonight. Sumitra, give us a summary of the rand's performance in trading so far today.
Well, a little bit better today, Rama. We saw about a 1% gain on the rand. So it strengthened a little bit and it came below that key 10 rand mark against the dollar. It was the first improvement in about 3 days, and it was a combination of factors that moved it, mainly the comments coming through today from the South African Reserve Bank Governor Jill Marcus. And of course, she put to rest that debate around interest rates. She said that, interest rates cannot be cut any further, essentially saying to the markets that the Reserve Bank has done all that it can, and now government really needs to take some serious measures in order to stop the strike action. She did say that the way we do negotiations needs to be changed, and we really need to cut back on wage negotiation strikes that usually follow through when these negotiations happen every year. So she, really stating that something needs to be done, really quickly in order to stop the rand's decline. But the Reserve Bank has done all it can in terms of cutting rates. It cannot cut anymore. We already are at historical lows, and inflation is ticking up. The other factor that helped to lift the rand today was the dollar weakness, and we saw there's data coming out tomorrow, key jobs data that's due out tomorrow, and analysts seem to think that May unemployment figures would have been unchanged, and really suggesting that all this excitement around a US recovery may not actually be the case. So we saw some dollar weakness there, and that also helped to lift the rand. So the rand trading at the moment at around 9.95 against the dollar.
Right. The Reserve Bank governor also did mention that the rand's weakness so far has had a relatively minimal effect on inflation so far. But what are the key upside risks that they're looking at with respect to headline inflation in South Africa?
Well, I think the rand still remains a major risk to inflation. Of course, I think the key thing to remember here is that the rand's weakness hasn't impacted on inflation thus far. So we could still see the impact coming through in the coming months. So it does still remain a huge risk. We already have inflation that's out of the 3 to 6% target band. And of course, if that ticks up further with this rand weakness filtering through, everything will become more expensive, from food, fuel, all of that. And that, of course, will push up inflation. We also have a very big trade deficit that is expanding at an alarming rate, and that's causing a lot of concern. And of course, we are importing a lot more than we are exporting. Although we are seeing a slight improvement in exports, we're still importing too much. And of course, that also adds to this concern. And the big concern here is the current account deficit. That, of course, all filtering into the current account deficit, that is ballooning. That's putting a lot of pressure on the rand as well. So another factor that's weighing on the rand here.
Right, let's look at the real economy. I understand that AMCU has essentially threatened to go on strike sometime next week, seeking recognition as majority representative of the workers at Lonmin's platinum mine. What is a key issue there? Has there been any reaction from Lonmin?
Well, AMCU is still busy negotiating with Lonmin this evening. I just heard a short while ago that it's hoping to find some sort of agreement or, reach some last-minute settlement with Lonmin. But the big issues here is really about Lonmin recognizing AMCU as the majority union. And of course, 70% of all of the Lonmin workforce belong to AMCU, but they're not being recognized officially by the mine. So this is what's going on here. So if they don't reach any agreement in terms of being recognized as the majority union, and of course there's also the salary adjustments that they're looking for. If they don't reach any agreement, they will go on strike. This is what they're saying. They will go on strike on Tuesday next week. But as I said, the negotiations are still continuing this evening, and AMCU is hopeful that there will be some agreement so that it doesn't need to go on strike.
We'll have to leave it there for the time being. Thank you very much for your time this evening. That's CCTV Sumitra Nadi shows live in Johannesburg with the latest developments from Africa's largest economy. With respect to the rand, 18% lower so far this year. Definitely not some good news there. We'll take a short break on Africa Live right now. Here's what's coming up next. We'll be analysing rising interest in Africa as an investment destination and the factors that are driving this interest.
BizAsia. Asia means business.
At 17:44 GMT, you're watching BizAfrica. The African Union's Jubilee celebrations in Ethiopia a couple of weeks ago offered a platform for several delegations from outside the continent to forge closer ties with African economies. Brazil, for example, cancelled $900 million worth of debt for 12 African states. CCTV's Yasser Kim filed this report on the reasons why African economies are getting a renewed burst of attention from investors.
The Economist calls it the hottest frontier. Not the weather in the continent, but the massive investment opportunities and potential wealth that awaits any investor in Africa. According to the IMF, Africa's total growth should hit an average 6.1% in 2014, exceeding global average growth of 4%. The UN says foreign direct investment into Africa reached $46 billion in 2012, up from $43 billion the year before, increasing its share globally from 3.2% to 5.6%, the fastest of all continents.
There are huge resources that are untouched in Africa. Oil, diamond, uranium and all forms of energy needed in developed countries can only be found here. It is also a fantastic market with a developing and a growing consumer population.
Brazil waiving $900 million of debt at the AU. Japan hosting Africa Day in Tokyo this week. And China topping the FDI list with $14.7 billion in 2012 are signs of confidence in the future. However, Africans still suffer from high unemployment, currency issues, security and malnutrition.
Unfortunately, the direct aid to Africa did not filter down to affect the welfare of the people of Africa. Most of this money was either mismanaged or it was handled with corruption. That's why the people of Africa don't feel any esteem for such an aid. This doesn't mean that all of this money was completely wasted.
Historically, Europe and the US have the most investments, but with the emergence of new big players with a different approach, which is the best path for the continent?
To have a system of scrutiny from the very beginning, to be transparent how much money is being given to the government, and it should be specifically for certain projects. And the best course is not to give financial aid, but to transfer technology and build joint ventures with the countries concerned. And also to train Africans how to establish companies, how to manage companies.
All eyes now are on Africa. But what is more important is that Africa itself make optimum use of its resources, not just the foreign states. This is Yasser Hakim for CCTV, Cairo.
The Australian mining firm Base Resources is still on course to commence commercial production from its Kwale mineral sand project in the coastal region of Kenya. Late last year, Kenya's then Environment Minister Chirao Ali Makwere unilaterally revoked 3 out of the 4 licenses issued to the firm, claiming it hadn't met the conditions stipulated when those licenses were issued. Base Resources has so far successfully challenged that decision in court, which at its core revolves around a government regulation which seeks to have 35% of all mining firms in Kenya owned by locals. I spoke to Base Resources Managing Director Tim Carstens earlier today. I started our conversation by asking him why, in his view, the problem with local ownership in Kenya is one of market structure and not a question of capital.
We did look at trying to secure Kenyan investment in the very early days, but there's no practical method for us to raise money in Kenya at the moment, for the simple reason that we can't list on the Nairobi Stock Exchange because we haven't had the history of profits. We're a new company. And also, while there's a lot of sophisticated investors in Kenya, there's no experience with mining. And I've spent a number of days or weeks over the last 6 months talking to the major investment funds here in Kenya about mining. And for most of them, that was the first time they'd ever been presented to by a mining company. And so there's a period of having to get familiar with the sector before these funds and these investors are ready to put their money in. And we're not there yet. There just isn't that appetite to take mining risk. But we are making progress. I mean, so far we've been able to get about 1% of the company, which is the Australian parent company, Base Resources, owned by Kenyans.
Looking at some of the cash flow projections you're making here, cash surplus of over $1 billion in a 13-year time frame, $550 million in cash flow for the first 5 years of operations. Wouldn't it essentially be fair to argue that, strictly speaking, Base Resources doesn't need to raise any more money at all?
We definitely don't need to raise any more money. So any increased participation by Kenya is not going to be by way of a new offer of shares. The point I was trying to make is that right now, Kenyans can buy as big a slice of this company as they want by buying the shares at the market price on the market. The interesting thing is that most of our major shareholders bought into the company at 55 cents per share. At the moment, we're trading at about 37 cents a share.
What kind of feedback are you getting in your roadshow at the moment?
Very positive. We've run a couple of site visits for these investors. As I said, we've got about 1% of the company now that's owned by local investors.
And these are institutional shareholders?
Mostly institutional, but there are a couple of high net worth individuals who have also come on. We're also we're working at the moment with CFC Stanbic, who are in the process of setting up a global trading platform, which means that anyone in Kenya who is able to set up an account with CFC Stanbic would be able to buy our shares on any of the exchanges in exactly the same way as they would buy them on the Nairobi Stock Exchange. That will really open up that opportunity. Now that's a couple of months away yet, but we'll certainly make some announcements about that when it's ready to go.
Let's make a quick run through the markets now for you. Flood of red ink right across some of the key bourses that we follow for you here. On Africa Live, the Nigerian market, however, the early gains that we saw of about 2 or 2 percentage points finally tapering off at the end of the day. The market ending the day about a 10th high, but still year-to-date gains of about 44 or so percentage points. The South African All Share also gaining in year-to-date terms, but on the day down by about a percentage point or so. The 20-share index in Nairobi also in the red. So far in the year, however, up 24.5 percentage points. And finally, the Egyptian market, the EGX 30, down in the red by about 0.2 percentage points. And on top of that, so far this year, it's down about 5 percentage points. That's BizAfrica for you. We'll have more news for you tomorrow.